Welcome back to the Ignite podcast. Today, we're delighted to have Arjun Dev Arora on the program, a longtime collaborator and friend of mine. Arjun, thanks for coming on the program. Would love to get an intro from you for the audience.
Yeah, thank you so much. Great to be here, and really appreciate it. And thanks for inviting me. So, yeah, I mean, just very briefly, managing partner at Format One, and kind of advisor and investor more broadly in the startup ecosystem. Very quickly, by way of introduction, so I've grew up in Southern California, went to school at UC Berkeley, go Bears, where we both
Go
went,
Bears.
and studied electrical engineering and computer science there. Did something called the Center for Entrepreneurship and Technology, so had a little bit of exposure to the entrepreneurial ecosystem through Berkeley, but it was still relatively nascent at the time. But fun fact, a lot of really interesting folks were in that program, like Tony from DoorDash, Vivek, the co-founder
Mm.
of Superhuman, Ryan, now at Kleiner Perkins. So
Ah,
it was a good kind of early genesis of the Berkeley kind of contingent of startup folks and venture folks. But anyways, from there, ended up spending a little bit of time in investment banking, so doing kind of tech M&A and IPO work, kind of mid-market at Jefferies Broadview. That institution had a long history of being kind of in the middle of a lot of really interesting things over even the kind of early days, kind of 90s and 2000s timeframe. So it was a wonderful place to land, and learned a lot, worked a crazy amount, but very grateful for that kind of foundational knowledge in finance, fundraising, business, capital markets, all of that good stuff. From there, went to Yahoo for a few years and a couple of years, and then ended up there leading business development eventually for Yahoo Real Estate. And that was as listings were going from offline to online. So things were going kind of from newspapers, bus backs, to actually having brokerages and real estate agents put their listings online. So it was a very unique time to kind of
yeah.
be in the internet. And I was, again, very grateful for that role and responsibility, because I was flying around the country convincing people, hey, you should really, put your listings online. The internet is cool. And it's a great way to sell homes or lease or get your mortgage rates or whatever it might be. So, and then from there, started my first company called Retargeter, and that was a wild and crazy startup ride, and happy to share more on that.
Yeah.
The short story there is we, grew that relatively quickly and had customers all over the world. And it was a fun time to be in kind of, again, in kind of digital marketing as it was going through a massive
Yeah.
change. Uh,
Yeah.
from there, long story short, ended up as a partner at 500 startups, and ended up kind of actively investing across the world in early stage, kind of what we would now consider pre-seed and some seed stage companies. We were doing somewhere between 200 to 400 deals a year. So it was very
Wow.
active, and a
Wow.
really exciting time to be there. I also ended up leading our efforts globally for fundraising and investor relations, which was a unique opportunity to kind of play on the LP side as well. And then, spent a little time at Expo, and now kind of doing, what I'm up to today. So that is the
Wow.
short intro, but excited
What
to,
a journey.
dive in. Yeah, it's been
So,
a,
yeah,
it's
so
been a
many
fun
cool
ride.
things. There's so many interesting things to dive into. I mean, the Yahoo real estate thing alone is really fun to unpack, and then we'll get to retargeter, of course, and
Hmm.
then obviously your venture stuff. But tell me about Yahoo real estate and kind of what
Yeah,
that was, and for those who may not
sure.
be privy to that
Yeah.
knowledge of
Well,
what the internet was like back then. Yeah.
back then, yeah, totally. So, I mean, at that time, I think the easiest way to think about Yahoo Real Estate in today's kind of universe is, Zillow and Trulia were at the time independent, separate
Mm.
companies, and were both maybe seed or Series A companies. It was very early, but they were kind of doing
Yeah.
something similar. At the time, Yahoo Real Estate was the largest online real estate site in the United States. So, Zillow and
Wow.
Trulia were just getting started. We actually ended up partnering with them and know those folks really well, and big fans of them. But at the time, it was the largest online real estate site. And so it was a place where traffic directed through the Yahoo homepage, which got kind of a Super Bowl sized audience every day, some of that would eventually trickle into, the real estate side, and then people would come directly as well. We had a really phenomenal SEO strategy back in the day, which worked really well
Yeah.
to bring in, folks who were searching for either neighborhood specific or whatever their search terms were. They kind of almost always ended up on Yahoo Real Estate at that point in time, even if they were coming in through Google or elsewhere. So that was kind of the genesis. It was a relatively small team, very entrepreneurial inside the Yahoo ecosystem. So Yahoo by that point in time had north of 10,000 people, but this was, I think, we were maybe sub 20-person team that kind of ran this property inside of a larger org. And a phenomenal set of people that I'm very lucky to have worked with, and they're all off doing really interesting things now as well. So that Yahoo kind of alumni network is absolutely phenomenal.
Yeah.
But it was a great
Yeah.
opportunity to just learn, how does the internet work? How does advertising work? How does display, cost per click? What are featured listings? Some of these kind of foundational first principles of the internet. I had a chance to learn just, you know, blocking and tackling, doing the hard work, getting advertisers, convincing people to put their listings online, getting the content, thinking about product, thinking about design, thinking about monetization, and running a tight ship. We were a very profitable entity as well
Yeah.
within the larger entity. So it was great, first principles lessons on running an internet business that I was, again, fortunate to have.
Yeah. And then what was the transition to retargeter?
Yeah, so towards, I guess, at some point in time, having had a lot of exposure to display advertising, at that point in time, there were companies like Blue Lithium that acquired by Yahoo at
Mm.
the time, and there was this kind of very, very early days of real-time bidded technology and kind of more programmatic buying of display advertising. In the past, people would have just said, "Okay, I'm going to do a block out on the Yahoo page here," and or I'll kind of slot in and get X number of impressions. But we were just at that moment in time at the cusp of this kind of revolution of being able to leverage data to purchase ads. And so, kind of on the back of that understanding and knowledge, got Retargeter started. And that was then an opportunity to, in the early days, just build, frankly, a very hacked together product using OpenX and a couple of display networks to kind of make it work in a very limited capacity. And then over time, this is a bit ad tech nerdy, but we ended up being one of the early partners of AppNexus, which
Oh yeah.
has subsequently been acquired by AT&T. But it was one of the very large platforms that started to allow you to buy ads across, not the entire internet, but a very big portion of the internet. And so we started partnering closely with them to kind of build the foundation of um, the like kind of infrastructure layer of retargeter, and then on top of that we built product and obviously go to market and everything, and then optimized and worked within the AppNexus ecosystem. So that was a
Yeah.
wild and crazy startup story. We bootstrapped it, from the early days for the first 4 years. Because we were in the business of selling advertising, we were able to get to revenue relatively early, even though the first versions of the software were wildly hacked together. At least people had advertising budgets, and we were kind of starting to come out of the GFC. This was 2008, 2009 timeframe. So there was some more spending going on, on advertising more generally. And so that was a moment where, the first 3, 4 years of that company grew very, very quickly.
Yeah.
And it was a fun to kind of be in that startup hustle. I mean, we hacked together the first product, then used an outside party to help us build the next version, then finally kind of brought engineering and product in house, and eventually got to a place where we were supporting some of the world's largest ad agencies and brands. So it was a crazy ride. A lot of lessons learned. I think just a lot of lessons learned around product, go to market, leadership, scaling, marketing. Of course, we were marketing a marketing solution to marketers, so it was very meta in that way. So it was a phenomenal opportunity to build something of substance, and then also, learn all of these crazy startup lessons. Again, I think that is where
Yeah.
we
And I
met.
think that's
Yeah, yeah, around that
originally where
time.
we,
Hmm.
yeah, where we met. It was, I feel like it was like a live ramp conference,
Hmm.
or maybe it was a growth hacking conference in
Yeah, that
Silicon
sounds
Valley.
sounds right. Yeah, I spent a lot of
Yeah. And
time
it was
around the
probably
growth
like
hacker community.
2012, 2013. I was running demand gen at a couple startups during that time before I switched to product. I remember you were a really captivating speaker on
Oh, thank
stage.
you.
I
Yeah.
was like, oh, I learned a lot from your talk, and I came up and introduced myself, and that's how kind of
Mhm.
originally how we met. And we kind of stayed in touch over the years, and
Yeah.
uh, yeah, kind of crazy how that all works out.
Yeah. I mean, I think it's interesting is that Silicon Valley is such a small place. If you are
It really is.
truly committed and dedicated to, the craft of building in and investing in startups, it's surprisingly small. And it is,
Yeah, you start running into the same people.
yeah.
Yeah,
Yeah. 'Cause, if you stay for 10 plus years and keep building, keep investing, keep, hustling, adding value, it becomes a very small world.
yeah.
Mhm.
And I'm curious, like, to unpack a little bit of the Berkeley story as well, because
Mhm.
I did Berkeley for my MBA.
Yeah.
I always thought I'd climb the ranks in products. I got the MBA because I was looking at all
Mhm.
the heads of product around the industry, and they all had MBAs. So I was
Yeah.
like, I
Right.
guess I should probably get an MBA. But it always struck me as like, Berkeley always felt behind Stanford in terms of its
Hmm.
entrepreneurship programs and
Hmm.
churning out startup founders and stuff like that. But it
Yeah.
sounds like right around the time that you were an undergrad, that was
Hmm.
starting to change.
Yes. Yeah. Yeah, absolutely. And I think that has only accelerated, from that moment forward. And there's been a lot of investment, both kind of by the university directly and then, from the alumni ecosystem and just the broader, even, Berkeley Endowment and the UCOP and other entities to just support kind of entrepreneurship at Cal. And those investments have now paid off, I guess 20 years later, but,
Yeah.
they're really starting to accelerate the kind of Cal entrepreneurial ecosystem. And, that is something I'm super excited about and remain engaged with in a variety of ways. I try and get back to Cal, maybe once or twice a year to speak at something or just connect with the kind of Berkeley entrepreneurial community. Cause I think that's what keeps it going. Just kind of putting in the time and
Yeah.
commitment. Yeah.
Yeah, we're connected with Skydeck. I'll
Hmm.
usually have one or two MBA interns at Team Ignite at any given
Yeah.
time,
Nice.
um, from Berkeley. And
Hmm.
no, it's just a soft spot in my heart for sure. Just all the value I got from that program and the network and stuff like that. So
Yeah.
looking back at Retargeter, I mean, this is
Hmm.
a nice. You had a nice 6-7 year run on this
Yeah.
thing. Kind of
Yeah.
when you look back and you look at the takeaways and the lessons learned.
Right.
I mean, for founders out there, what would you
Hmm.
tell them?
Yeah, I think that nowadays this term is very top of mind or timely is this concept of kind of founder led sales. So I'd say the first few $1 million of revenue were probably very aggressively driven, or led by by efforts, and not we had a phenomenal team, and I give them all the credit in the world, and they were absolutely amazing. But a lot of the ability to kind of just catalyze that early kind of kinetic energy to get things moving and open doors and push and test messaging and ensure that always kind of doing customer development work and looking for true product market fit, the right ICPs. A lot of that has to be kind of founder led at the early days. Again, not to take away anything from the incredible team, but just the act of being in that role and pushing really hard is what is required to I think get the flywheel spinning on the go to market motion. And I
Yeah,
think in this, non ZERP environment that we've now exited from, um, the requirement to be very much founder led in the go to market side is absolutely critical. And the same thing goes for the product side. I think that's something though that has been talked about a lot and is kind of with Andreessen's kind of investing in, product led founders or PMs coming out of other places. This mimetic has been flowing around the ecosystem for a long time of CEO and founders need to be close to product. But I think maybe the non-obvious thing would be, and particularly in this now new market environment, the learning around founder-led sales and digging in that capacity, I think
yeah,
is really important. So that was definitely one of those, I think, key lessons from that experience. The other thing was investing in long-term marketing, and you of all people will appreciate this. But as much as it's important to get those leads today and get those MQLs and SQLs, as the case may be, it's equally as important to set up the system and the foundation for long-term marketing thinking. So that's content generation,
yeah.
that's a commitment to social, that's a lot of other um, softer things, PR, events, that ultimately
Podcasts.
podcast, yes indeed, that lead to long-term
Yeah,
marketing lead flow. I still remember we wrote an article called "What is Retargeting?" In the early days, and it was kind of just good to have on the website. Really, is how we thought about it, and eventually, the vast majority of our leads actually came through that article, which was crazy. It
yeah,
was a simple, you know, relatively short article about what is retargeting, but because we wrote it early, because we ended up linking to it, and because people found it valuable, it ended up at scale generating a tremendous amount of leads, and we tracked
yeah,
everything with HubSpot and Salesforce and all that good stuff. So, I think that was another key and important lesson. And then I think the last piece was really around um, just leadership. I mean, so many incredible lessons on how do you build
mm,
and maintain a company culture? How do you scale? How do you align incentives the right way? How do you reward the right behavior? How do you,
mm,
have accountability when there isn't the right behavior? and then how do you ultimately, like, make sure people take care of each other and support each other even after the kind of story is done. And so Ben Casanoka and had written a book about, it's kind of that tour of duty aspect to things. And so, yeah, you're here for a short period of time. It's very intense. We're all aligned and clear on incentives. Let's build towards something great together. And then when you're done, you're part of this amazing alumni group. And,
Yeah.
one of the greatest joys today is having, an email thread with like employees 1, 2, 3, and 4 at Retargeter, and just, laughing and sharing stories and, having a good time. And I think being able to build, and maintain that culture, I think is really important. And then supporting those folks, and each of us supporting each other. It's not just me
Yeah.
supporting the team, it's them
Yeah.
supporting me, and, and each other over time. So it's just really cool to get those text messages and those emails over time. And that only happens if you're incredibly deliberate collectively about building a culture that, is aligned and clear, and values driven. So that, I think, was another really critical learning from that whole experience, and one that I try and help founders with today.
Yeah.
Mhm.
Yeah, I love that. I love that positioning that you're kind of hinting at, which is, we're only together for a short amount of time. I remember my wife ran this pretty large team at LinkedIn, and
Mhm.
they had this saying that you graduated from LinkedIn. You never kind
Yeah,
of,
yeah.
it wasn't like you left LinkedIn. You graduated and you're on to your next
Mhm.
play. I mean, because if you think
Yeah,
about what LinkedIn does, it enables professionals to find new work and new jobs, right? And so
yeah,
they kind of embrace that culture there, is like, how do we set you on a better trajectory than when you came into the company?
right.
And I always like that positioning, is like, we're trying to inflect the curve of your career here
Mhm.
and make you more effective and a better leader and things like that, rather
Yeah.
than regretting kind of the turnover, or regretting
Mhm.
the loss of somebody leaving. It's like, no, this is great. They found something even better for them, and
Mhm.
kind of, you're part of the alumni group. I
Yeah,
love that.
exactly. Yeah. So
And so
that's
tell us about kind of the
mhm.
the the end of this journey, and kind of the start of that 500 startups
Yeah.
journey.
Yeah, so from Retargeter, I ended up kind of moving to the CEO role. Oh, sorry, moving to the chairman role. We ended up bringing on an external CEO who helped kind of get the company sold, and then I started at that time kind of working on another company for a brief period of time. That was a short stint, but anyway, that company got acquired by New Relic, and it was kind of relatively quick. And there's a longer story around kind of rebound relationships in entrepreneurship, and Charles Hudson has a phenomenal uh, piece of content around this kind of thing that happens with founders who just want to get right back in the game. And I was kind
Yeah.
of doing that, and so I think there's one takeaway or lesson that I could share, is that I ended up learning through that experience that it's really important to take a lot of time and space, especially if you're something that's been a key part of your life for 6 years and at this
Yeah.
level of intensity of being a founder. It's important to take time and space. And so I think, having, two
What
months,
is that rule of thumb? Is it like a month
yeah,
per year, maybe, or something?
that
I mean,
sounds
what's the?
about right. And then
Yeah.
probably chuck on another 20% just for good measure,
Yeah.
I think is probably right. And
Sounds
that,
right.
yeah, that helps just ensure that you really have space to digest the entirety of that startup experience. Because no matter what happened, whether it was good, bad, great, it has to uh, integrate, for lack of a better term. And then from that place, I think having learned the lessons, having processed the hard part, then I think you can go to start something new. And so I think that if I were to share, one kind of lesson from that transitional moment, that would probably be it. Just good
Mm.
to take lots of time and space in between things. And again, Charles Hudson has a great blog on this topic in a bit more detail. Um, so yeah, from there, then ended up at 500 startups. I came in as an EIR, initially, just thinking, yeah, this will be a good place, to hang out. I know a lot of the folks. I randomly happened to be an LP in Fund One of 500 because Heaton Shaw, way back in the early days, was like, "Hey, there's this crazy thing called seed investing. It's happening. 500 startups is doing it in a really interesting and unique way.
Yeah. What year
You
was
should
that?
learn more." I want to say that was maybe 2013, 2012,
Ah.
2013,
Yeah.
when ended up becoming an LP in Fund One.
Nice.
really early,
And
and
that
that
fund
fund
did
has done
well
very
too,
well.
right?
Yeah,
I mean that,
extremely well. Yeah,
and then
and there's
part of
still
the
some left to
thesis of
go.
that
Yeah,
fund, like what made you invest? Like what you looked at it and you're, I mean, it's obviously a friend of yours and somebody you've
yeah.
known, but what was it about the thesis at the time in 2012? You're like, okay, yeah, I should throw some money at this.
Yeah, I think, I at that point I'd been a founder for a while. I'd seen a lot of startups. I had a lot of founder friends, some of whom were actually funded by 500, and I was just starting to see this kind of massive growth in early stage startups, and some
Hmm.
folks who were growing incredibly quickly. And the way 500 was thinking about it was kind of at that time was like on the ground in the weeds, talking to founders, helping them out, understanding the ecosystem. Like it was a classic emerging manager hustle story, right? There's emerging managers who are ready to put in the work and are on the ground, spending the time and really calibrating, tend to outperform. Cambridge
Yeah.
Associates has data on this. Like it's kind of a well-known thing now. And there's a great example of that. And so I didn't know all that detail. Probably didn't even know who Cambridge Associates was at that time. But I think what I did appreciate was that they were on the ground, they were being helpful, and they were seeing a lot of really interesting stuff. And they'd invested in some
Yeah.
companies that I knew were really strong. So I
How,
think
how
that was
much how
enough.
much how
Yeah.
much can venture funds actually help startups versus how
Hmm.
much of their strategy was just, hey, very high volume of seed investing will yield great results, right? Because if you
Yeah.
hit the index for seed,
Hmm.
if you look at various data sources, it's like
Yeah.
30 to 40% IRR, right? So
Hmm.
like how much of that was just like, hey, right strategy, right time?
Yeah. I mean, it was definitely that. I think
Yeah.
if I were to summarize it, it was that. I think the other things were nice to haves, but
Hmm.
the essence of it was right strategy, right time, which was,
Yeah.
the ecosystem was burgeoning. It was cheaper to start a company than ever before. There were a lot of very, interesting and aggressive folks who had some reps in the broader technology world by that point in time
Yeah.
because
And you
of,
had this confluence of
yeah.
mobile and cloud at the same
Hmm.
time, sort of reducing the upfront capital needed to create a SaaS company, basically,
Exactly.
right?
Yeah.
Just all
And
of
it
a
was the
sudden,
beginnings of
yeah,
that. Yeah. This is the year of mobile conversation that happened for subsequent years. It was always the year of mobile from kind of, 2010 to
yeah,
2030 or whatever.
yeah. It was like
Yeah. No,
five
this
years of
is the
mobile.
year. Yeah, exactly.
Yeah, nobody ever
Um,
talked about cloud as an enabling technology, but it was sitting there in the background, enabling people to
mhm.
spin up SaaS companies for, pennies on the dollar, basically, with a bunch of AWS credits and stuff like that.
Exactly. Yeah. So I think all of those things led me to invest, back in time. And then I built
Yeah,
a relationship, with them, having been an LP and just having been investing in and advising companies around the 500 hoop. I think that, was great. And for the record, I was very fortunate that they ended up taking a small check from me. I was not writing huge LP checks into those funds, but I think they, again, were gracious to accept my small check, and so I got to be a part of the story and understand it from the early days, just to set expectations on that. Um, and it was a way to kind of commit to the ecosystem, which I think is
yeah,
really important, right? I think if you're in the ecosystem and you commit not only with your time and your energy, but also your dollars that you're making from the ecosystem, you kind of go all in, right? As
yeah.
people say, to to make great wealth, you have to concentrate. To preserve great wealth, you have to diversify. And
Mm,
so I was definitely kind of in that moment of, and I'm still in that moment.
I love that. I've
I'm
never
still
heard that.
always investing in the startup world
To
and venture
create
world.
great wealth, concentrate. I like that. Yeah,
Hmm.
and you can. I mean, in any sector or asset class, you can create great wealth, but you have to really, really focus.
Yeah.
But once
And you
you've
have to
made that
live it
wealth,
and
yeah.
breathe it and obsess about it and understand all the different aspects of it. And then I think from that place,
Oh.
if you concentrate in that way, then you have kind of a sixth sense for how things are moving over time, and then that allows you to, I think, build value, create value, build wealth personally, and for your team or whatever.
And then so 500 startups. By the time
Mhm.
you join, they're probably what, on fund 3 or 4. How had
Yeah,
their
fund four by
thesis
the
and
time I
way of
joined.
yeah, how
Yeah.
how had their thesis and way of investing changed over the years and maybe
Mhm.
since? And how did it inform what you do now? Yeah.
Yeah, so I think at that point, what happened is in the early days it was just kind of active seed investing, so it was writing checks directly into founders. By the time I'd started at Fund Four, was pretty the accelerator program was pretty dialed in, and I think the other thing that was happening was that there were starting to be emerging funds in emerging geographies, and so what had happened from my initial entree into 500, which was, hey, we're going to write seed checks very quickly into great companies, and we'll do it with speed, and we'll write small checks, non lead checks, into kind of a fully functioning accelerator program, coupled with the ability to continue to write seed checks in the way that was done before, coupled with kind of spinning up emerging funds and emerging markets, and a little bit of fund to funds activity as well out of my
Wow.
entity. So it was this really unique way to kind of have exposure to all of those different aspects. Now, kind of the accelerator was the vast majority of where the dollars were deployed. And so that's where I ended up kind of being an EIR focused in, that division, for lack of a better term. And then eventually, of course, I did seed deals and I supported a lot of the emerging fund managers and, even went to AGMs for some of the portfolio funds. But in the early days, while I was in EIR, I was just in the office when the program is running, working with a dozen odd companies on a weekly cadence, just trying to be as supportive as possible, meeting new companies. And then once the program ended and we had our big demo day, then it was back to like, meeting as many founders as possible for the next batch. And so it was a incredible fire hose of working with and supporting, really great founders who were all, this was pre-pandemic, were in the office on Fourth and Mission, working together every day in community, supporting each other. So it was awesome. It was a
Yeah.
phenomenal experience. Yeah.
And walk us. How many investments did you end up making with 500?
Oh man, I probably touched, at least 200,
Wow.
and then directly where I kind of led seed deals. We were more focused on the accelerator, but there were probably maybe a handful of seed deals that I ended up doing as well during my time there, where I kind of
But you
led
might,
them and got them pushed through the IC. Yeah.
yeah, and you might
Mhm.
call those nowadays, 5, 10 years later, pre-seed.
Yeah,
Would that be accurate?
that's accurate. Yeah, if I think
Yeah.
about the ones that I did, they were almost all pre-seed deals. Yeah.
Yeah.
And then the accelerator deals were absolutely pre-seed deals. Like those are the
Yeah.
definition of pre-seed, I think. Yeah.
Right. Kind of post-launch, post-revenue, very little revenue, maybe
Yeah.
just an idea or a
Mhm.
POC, an MVP kind of thing.
Exactly. Yeah, that
And
was
then
that.
so you touch a couple hundred deals, and then at some
Mhm.
point you're now thinking about transitioning to Format
Mhm.
One. Tell us,
Yeah.
yeah, walk us through that journey.
Yeah, so there, summer 17 was a unique moment for 500, and so there was a lot of parts that were moving and shaking at that moment, and so I think at that point it made sense for me to transition. Fund 4 was 100% called and 100% deployed, and it was a good time for me to kind of move forward. And from that place, ended up at Expa. So a good buddy of mine, Human Radfar, now the CEO of Collective, um, was a partner there at the time and kind of actively involved in supporting this kind of venture studio plus venture fund, the Garrett Camp, the founder of Uber, had started. And so,
Hmm.
initially I just kind of went over there to hang out and say, hey, come by, help out the fund, help out the portfolio, meet some companies, just generally be a resource. It's a great opportunity. Super grateful to him for, creating that space, since I called it like an XIR program or something. But
Yeah.
anyway, from there, had some time and space to kind of decompress from the 500 experience, just be generally helpful. And then started to kind of have this, broader thesis of, love supporting founders and being helpful to them in all the, the hard things, the things that matter, the things that move the needle. And so it's both kind of a tactical piece and then kind of a executive coaching and a leadership piece. And so that's how that ended up, coming to fruition, is the ability to support founders on kind of both of those verticals in one, meeting, in one kind of group together, and have the ability to have that support. So that's where I met my partner John, he and I shared the same executive coach, so he kind of brought that element to the table, and I brought the other side, and we were able to kind of come together and start supporting founders, in that way.
Yeah. And so then you guys go out and you raise your first fund, and
Well, actually, we're not a fund. So what's unique about our
okay,
approach is
right.
that we are, um, more kind of advisors and coaches than we are necessarily fund managers. So
That's right.
the
That's right.
investing that I do is personal, and just kind of more as an angel or an LP, versus through a formal entity with its own GPLP structure. So we do our support in kind of an advisory and coaching capacity, and that's on a weekly cadence. with the founders that we work with, and a couple of funds as well. And
Yeah.
that's how that works. Yeah.
Yeah, walk us through that
Hmm.
engagement, what that kind of typically
Yeah.
looks like. You meet an
Sure.
interesting founder. I'm sure you have a lot of inbound. There's
Hmm.
more startups that want to work with you than you have
Yeah.
the time and capacity for. So how do you
Fortunate
kind
to
of
be
go
in
through
that
that
place.
selection process, and yeah,
Yeah.
what's that engagement look like?
Sure. Yeah. So I think, what it looks like in practice is kind of an hour, half an hour to an hour a week, depending on what's needed. And, with the founder on a very rigorous weekly cadence. So that is, same day, same time every week. And that allows for continuity of, you know, understanding, context sharing, just, being able to kind of check in and provide accountability. And it's really around, moving the needle on the things that matter. So, 2 years ago, it was a lot of fundraising, and then it became a lot of
Mm,
managing cost cutting and layoffs and bridge rounds and, messaging to the team and communications around this kind of, changing market environment. And I think, this year we're kind of getting to a lot of founder led sales, to my earlier point, and then also kind of back to fundraising a little bit, though I think there's still an opportunity for that to continue to accelerate. And I think it will probably
yeah,
into 2025 is when we'll be kind of quote unquote really back. But, let's see. So those are kind of the areas tactically where, have spent time supporting founders, and all the while kind of helping them think through their leadership style, help them improve their
yeah,
communication internally, externally, manage their own, emotions and thinking as they kind of go through the, craziness that is and the
yeah,
rigmarole that is being a founder. So that's kind of the support. And, our goal is to be incredibly helpful, like on orders of magnitude more than what we charge. And I think, fortunately, because I've done that for a long time now, continue to work with some incredible founders, folks who've been
yeah.
backed by all the usual suspects, everybody from, Andreessen and Excel and Menlo and Founders Fund, back founders who are somewhere between typically right before the A all the way through, kind of through the Series C is where we typically spend time.
Okay, so late seed to kind of B and C. That's where you guys kind of specialize.
Hmm. Yeah, that's the
And
moment where you're going from kind of PMF to company building. So
mhm,
that's why you're going from maybe it's a team of 15 odd folks that've got something working to, okay, now we need to really accelerate, put some structure, some systems, some process in place. And as a leader, it goes from, I can reach out and kind of chat with anyone, virtually, metaphorically speaking,
yeah,
to, okay, now I've got, layers of leaders and I've got to think through how my communication and messaging and how I show up impacts the rest of the org, particularly for those that are grow quickly from 15 to
mm,
100. It's even
yeah.
more critical, um, that,
Yeah, when you're
you
five or
kind of get
ten
that.
xing your revenue year over
Yeah.
year, it's a great problem to have, but it is a
Yeah.
problem.
It is a problem regardless. Yeah. And
No,
if
I
you're
mean
not
you
5Xing, how do you figure out how to 5X is
right,
then the question. Yeah. Mhm.
right.
Yeah.
Yeah, either way, it's a problem. There's always fires to put out. So you could have easily coming out of 500, as a partner, raised a fund
Yeah. Mhm.
versus done this alternative
Yes.
advisory thing.
Mhm.
Walk us through that decision, how
Yeah.
you decided to do more of this kind of advisory of startups versus doing the traditional GPLP kind of fund.
Yeah, I think very personal reason is that we're having kind of a family at the time, and so our daughter was born about 4.5 years ago, and so wanted to be able to spend that quality time, and then soon thereafter the pandemic happened,
Yep.
and then really and then our second child was born. So the kind of desire to kind of have that quality family time, particularly in the early years, and have a little bit more kind of flexibility in the schedule,
Yeah.
and having supported a lot of emerging managers, I knew that I would have to probably be on the road for 18 months straight, at that period of time. And
Yeah.
so
Well, it used to
that was
be,
something. Yeah.
especially before COVID, you have to
Mhm.
be out on the road to fundraise.
Yeah,
And I
exactly.
don't think that's as much the case anymore, but definitely
Mhm.
2018, 2019, that was the case.
Yeah, exactly. And funny enough, I think it's actually coming back now. And we could spend some time talking about the emerging manager piece as well, because I've been spending time supporting a handful of emerging managers over the years, whether it's through various programs like Coolwater or other
Hmm.
things.
Hmm.
My time of 500, just really, enjoy supporting the emerging manager ecosystem and an advisor to a handful of really great, emerging fund managers. But, the ability to raise that capital is non-trivial, and requires a real commitment, as you of all people appreciate. So, yeah.
Yeah, it's
Mhm.
and I think VCs kind of get this bad rap of we're just out skiing in Park
Yeah,
City or whatever.
right.
But actually, it's a lot of work,
Yeah.
and it's kind of interesting to hear somebody that been there, done that, and has counseled a lot of emerging managers. Yeah, fundraising and investing in startups is
Mhm.
not a 40-hour a week job.
Yeah, yeah.
It's at least 60 to 80, and
Yep.
yeah,
Mhm.
I mean, it's not as hard as doing a startup by
Yeah,
any
yeah.
means.
No,
Like
that
startups are
that is
way
correct.
harder,
Yes.
but
Mhm.
getting a fund off the ground is pretty tough.
Yeah.
I'd love to unpack that. Like, how do
Mhm.
you
Sure.
how do you advise emerging managers and
Mhm.
the fundraise and invest in startups? I mean, obviously you've done over 200 investments.
Mhm.
Yeah, kind of. I'd love to talk about that.
Yeah, I think, the on the emerging fund manager side, I think initially it's really about figuring out, who you are. It's very much a know thyself exercise. And because the kind of GP market fit is just as important as kind of, founder market
Mm,
fit is in, let's say, the startup ecosystem. So, what is the emerging manager's unique skill set, vantage point, network, understanding of a particular market, or let's call it the broader startup market if you're going to be more of a generalist. um, and what can you bring to bear in that space? And the venture comes down to seeing deals, winning deals, supporting them, or deciding and then winning those deals, and then supporting those companies as kind of the core activities.
yeah,
So where does an emerging manager have an edge in being really sharp about that, so that it is differentiated? It doesn't need to be, oh, I'm a fintech investor in Indonesia. It can also just be, as a generalist seed investor, you can say, hey, I bring connectivity into larger businesses, or I understand customer success really well, and so I'm able
yeah.
to help people do that. So differentiation doesn't always have to be in vertical geography, or stage. It can mean a lot of things, but that
Yeah.
differentiation regardless is critical.
I remember when I got started, I spent a couple of years as an LP and angel. And when I
Hmm.
started Team Ignite, which was a syndicate originally,
Yeah.
I remember a VC acquaintance, I wouldn't call him a
Hmm.
friend at the time, maybe he's a friend
Hmm.
now. He's like, well, why would anybody take your money?
Yeah. It's great. That's a good question to
Yeah.
ask. Or
Yeah.
to be asked. Yeah,
It was kind
exactly.
of, he kind of said it in a dismissive way though.
Yeah,
And
right.
but he was right. It was like, I was
Yeah,
like, yeah, what is unique about my money? What
right.
is
Hmm.
unique? What gives me the right to be on a cap table? That's a really interesting question that emerging managers, to your point, really need to answer. And then I'd love to hear your take on investing. Right? I mean,
Hmm.
you've done at least double what I've done in my career. So I'd love to for the VCs and angels out there. What
Hmm.
are some of those tidbits and things you've picked up over time where of making hundreds of investments? Impart the wisdom.
Sure. Yeah, sure. To the extent, still a work in progress. Have had some successes, have had some tremendous
Yeah.
failures, but I would say, what I've learned from my perspective is understanding, kind of goes back to that founder piece, and particularly being an early stage investor, like really understanding the archetype of the founder. How are they wired? What's their level of commitment uh, to whatever they're building? And, you kind of look for that glint in the eyes of their ability to kind of
Yeah.
break through walls and do whatever it takes. And that, I think, is really, really important. And there's this old adage, VCs always say, oh, it's pattern recognition. Like, what does that actually mean?
It
I
kind of
think,
is. It kind
yeah,
of is though, right?
yeah, it is. And I think what that means is looking for that ability for a founder who can both, be incredibly gritty, bust through walls, will work, very, very hard, but is also at the same time smart in a variety of different dimensions. So not
Mm,
just, IQ, but also EQ and cultural intelligence and, general awareness around and capital intelligence. Like, do they understand how money works and, funds are raised, or can they learn that quickly? Are they coachable on the things that matter? So those are all the elements
yeah.
of, I think, what makes up, um, this kind of pattern recognition that VCs talk about. I think all of those things, when you look at a founder, are the things that end up,
Yeah.
mattering a lot. And then the other, equally as important side on the business side, the strategy side is, is this a big enough market to actually justify a venture level scale, or can their sequencing into a subsequent and adjacent market that is of that size, does that feel rational and um, real? So okay, yeah, I'm starting in black cars in San Francisco, but can I really build something that can tackle transportation globally? Okay, do I believe that path forward is a credible one or a possible one, and what has to go right for that to be possible, I think is another thing to think about, market.
Yeah.
And sometimes when the market is too huge and there isn't a wedge, that's also can also be a red flag. It doesn't have to necessarily always be a good thing. So it could be, well, this is, red ocean, it's super competitive. How are you actually going to be differentiated? Where are you going to start, instead of just saying, oh,
Yeah.
I'm going after everything in this massive, massive market. So um, there's some of the elements on market. I'm also pretty obsessive about product and design and just thinking through how people think through product. So I was fortunate to intern it into it a long time ago, and I think that
Oh wow.
informed a lot of my,
Yeah.
um, just passion for product and being very thoughtful and customer centric, and doing customer journeys, looking at product from a systemic way. What are those customer stories? What are they actually trying to accomplish? Really understanding, does the founder have the capacity to have customer empathy,
Yeah.
and then is it reflected in product? You can have customer empathy and then you can't actually translate that into your product, or you could be an absolutely brilliant product designer but not literally not hear your customers. And I've seen that happen. I think those are the things that I look for on the product side. On the
Yeah.
traction side, it's a little bit more around, it's hard sometimes to pre-seed. There's very little traction or rare traction, but I think there are ways to suss out, is this real? Is this traction that matters? Are these people ecstatic to be using this software? I think about, myself and Superhuman, just to use an example of, a great product in early traction. There weren't a lot of users, the co-founders or buddies, when started using it, and I was like, I know myself and a handful of other people absolutely, now that I've used this for a month, cannot live without it. And
Mm.
so after having had those conversations, with a few people, then that becomes, even though the traction may still be just, a couple hundred users for a product that, would need to have many, many multiples of that to be a venture scale, that
Yeah.
was an early indication that, oh, wait, this is real traction. Now they just have to find more folks like this. And do I think there's enough of them? Yes. So that's kind of the traction piece. Design matters a lot to me. I think a lot about design. It doesn't mean that it has to be look beautiful like Airbnb, all the time. But
Yeah.
are they thoughtful about design? Are they implementing design where they are with the resources that they have available in service of the product and the go to market, the traction? So that's something that I, often think about as well. So I don't know,
Yeah.
those are some of the various things I look for. And then the other reality is that this is a social game, so social proof matters. Who are the advisors, investors, co-investors?
Right.
Because that is indicative of an ability to kind of continue to galvanize people and raise more money over time, as well. So I think looking
Yeah.
at that with a thoughtful lens and not get caught up in the hype. Yeah, oh, this person's investing, and we've seen that happen in this ecosystem multiple
Oh
times.
yeah.
I'll spare
Yeah.
the specific names, but I think you can probably think of them
Yeah.
where, oh, all these great investors are in. I got to jump in too, and then we later realize it's a fraud or whatever. So
Oof.
you have
Yeah.
to be careful of
Yeah.
that. But I think if you do that combined with all the other elements, and you're thoughtful from a first
Yeah.
principles perspective, then I think that's a sufficient signal in the game.
Yeah, I love that. Of all those things you described, are there anything that are must-haves, or stated another way? Are there any of those things where you're like, I can overlook that because everything else is so strong?
Yeah, the things to overlook, maybe looking at it that way, I think if there's coachability on, learning how to fundraise, if there's coachability on some of the like nuances of go to market and product, I think that can be quote unquote overlooked, because
Mm.
as long as the founder is receptive to and on a aggressive an exponential learning curve around those other topics, what you're looking for is acceleration, to use the physics metaphor, around those topic areas. Not necessarily the velocity today, but are
Mm.
they capable of accelerating into learning around those key areas around go to market, fundraising, product? And if so, and you can understand that, then great. Then I think you can still invest because you know that they're committed to learning those
Yeah.
things and they're pushing hard to figuring that out. Then totally fine. No,
Yeah.
no worries. Because if the other things that aren't those are done really well, like exceptionally well, then there's more comfort in allowing those other things to accelerate or grow over time.
Yeah. I think the way I describe it to people is every startup and founding team is they're like a snowflake, and they're unique. And
Yes.
there are lots of easy no's in this industry. Probably 80-90% of what I look at, it's like, that's an easy no. That's an easy no. And then there's like easy yeses. Every like once a month, I see something that's like, yep, that's an easy yes.
Yeah.
And then there's like everything in between, right? Which is like you have to squint at it, and you're like, the team's pretty good, or the market's pretty good, or the timing is almost perfect. And then you're just trying to kind of suss out a little bit of, what you don't like about the deal.
Right. Yeah, exactly.
And it's hard, it's hard as an investor to be intellectually honest with yourself, I think.
Yes.
Because, we make so many mistakes, right? And I think that's another benefit of the high volume strategy like 500 Startups has is you get a lot of at-bats, right? It's kind of like going into the gym and taking 500 3-pointers.
Yep.
You're probably going to get better at 3-pointers, you know?
Yes.
And just same with investing, right? It's different if you're concentrating and you're only doing 20 deals over, call it 3 or 4 years. That's like, wow.
Yeah.
You're really getting...
And you're really going to know if you're good after 10 years or 7 years, let's say, and, multiple funds in that instance.
Yeah. But if you're investing in, call it 100 a year,
right,
you're going to learn a lot. That second year, you're going to do better. And that third year, you're going to do better. And that's why I love being an early stage investor is, there's the easy yeses and there's some where I'm like, it's almost an easy yes. I'm just going to make the bet, because there is some chance. There's some chance that this will, go 1,000x, and I'm just going to take the chance.
Yeah, totally. And I think as an investor, you have to have that moment of introspection as well to say, hey, what did work here? What didn't? Why was this a success? I think of one company in particular, invested at Series A and ended up becoming a unicorn and then exited for all cash, right? It's like, okay, awesome. That's great. But like, why did that, why did that happen?
Why did I do that? Yeah.
Yeah. Why did I do that? What did I learn from that? And what were the key lessons in there? And I think if I were to look back at that example in particular, it was purely a founder-based bet, like in that instance. And, it was a competitive market, but it was like, hey, this founder is uniquely wired to just run through walls and figure this out in a thoughtful and intelligent way.
Yeah.
And that, that makes sense. So,
and it's hard to suss that out as an investor or an advisor in what you do at your firm. But, what are some of those things that you look, is it just a feeling you get when you're talking to somebody, or is it the stories they tell? I mean, how do you suss that out?
Yeah, I think it's the stories they tell around how they got to where they are, starting from inception as early as they're willing to share.
Yeah, I had a paper route at 13, and then I started a business at 14, and like it's those kinds of stories, right, where they're gritty and entrepreneurial and
right. And also the other things to listen for are stories of learning. Like, where did I learn something and integrate that quickly, like very quickly? So, hey, this wasn't working. I went and, went on a rabbit hole in YouTube, learned the thing, fixed it the next day, and then all of a sudden things accelerated. Or, here's how I understood the needs of a customer, or, maybe even my boss. I worked at a big company and I figured something out because I was paying attention, solved that problem, for my boss or my boss's boss, and got a promotion. Like, okay, that's an interesting indication of high agency, creativity, get things done, sort of, so you can listen for those stories. And they don't all have to be, oh, I worked at these 3 startups back to back. It can be even the most random thing that I think helps over time give you that confidence.
Yeah. Well, I'd love to, we're going to run out of time. I could talk to you for hours about this stuff, but how do you see kind of the next 5 or 10 years of startup land? I think AI is now infiltrating software and generating more software, and we're in the midst of a platform shift. And you saw the rise of seed investing. You were there, front row seat. 10 or 15 years ago with the advent of cloud, which we talked about. And how do you see the next 5 to 10 years in our area, in our space?
Yeah, I think, the institutionalization of venture capital is in full force. I mean, I think you look back to like private equity or hedge funds, like that is something that is happening. So I think, eventually after we get through this slump, we're going to see more creativity in the kind of venture asset class more broadly. I think we'll see more capital in the asset class. We'll see more unique structured points of view. I think there'll be a churn in some of the larger funds as some people, call some of the older general partners call in rich. So I think we're just going to see a lot of
Colin
let's
Rich,
call
I
it
love that.
call in rich. Yeah, it's a phrase
I love that.
has
I
been
love
going
that phrase.
around these days. Yeah, it's a good one. Um, and
Colin Rich.
so they're going to go out. The next crop will come in, and I think those folks have their own unique
There
vantage
is a
point.
natural cycle to this whole industry, right? Where
Yeah.
you got the young emerging managers working super hard, and they tend to outperform, right? Because they're running these little $5 or $10 million funds, so they knock it out of the park for the first 2 or 3 funds. Then they raise massive, gigantic funds, and then
Yeah.
it's like, oh crap, how do I go deploy the $300 million in the seed stage? I guess I'm a
Yeah.
Series A investor now.
There you go. Yeah, and that sort of thing happens. And even at the large firms, they're also going through their own churn moments as well. But I think that's at the industry level, and then talking about the kind of product or technology level. To your point around AI, I think finding companies that are actually still solving real customer problems, right? I think we saw this in web, we saw this in crypto, we saw this in mobile. Oh, it's going to change everything. Everything's going to be different. But at the end of the day, unless you're still continuing to solve true customer problems, I don't think anything's going to change just because you tack on AI or you build something with AI in it. That being said, if you're a Series A B company that deeply understands your customer and you're able to interject AI to accelerate a workflow or understand and synthesize data better or support your customers better, I think you're going to have a huge advantage. And I think if you're a new company that's using AI from inception to solve a core customer problem, but come at it from a place of customer empathy, then you might have a shot at taking out some incumbents in your space. People that used to use workflow to solve problems, can you now do it via chat or voice or even passively or invisibly in the background because you're leveraging AI in a unique way? So those are things that I think we'll start to see more of in the future. And I think data will still be the importance of data only accelerates, doesn't decelerate. So the data that you have in a proprietary fashion, when supplied to thoughtful AI algorithms, either those of OpenAI or Anthropic or Hugging Face or ones that you develop in house, will allow you to uh, accelerate your startup journey and help your customers in more ways. So those are just things that are top of mind right now as I think about, not to be a naysayer, I'm very actively excited about AI. I just think how it actually shakes out is going to be a little different from some of the aggressive hype that we're seeing, more broadly in the press. But
yeah, the way I describe it is we're probably in like the mid to late 90s of AI. Kind of where the internet was. Like ChatGPT, we might look back and go, that was like the AOL of AI. You got mail, and wow,
totally.
cool! I can chat with this chatbot that knows everything, and kind of an aha moment, but also kind of not the end game.
Exactly.
Not where it's going to end. So very exciting. So for the founders out there listening, what should they know about working with you? How do they know to reach out to you, and how do they reach out to you?
Yeah. I think, pretty active on Twitter and LinkedIn, so easy to find there. And, easiest way is just through a warm introduction through somebody, that's probably the fastest way. But
Come to Team Ignite, get an intro.
There you go. Easy. Problem solved. And then, I think, in terms of working, work with us, I think it's a intense and needle moving exercise is probably the best way to think about it. And, love working with the aggressive, gritty founders who really are ready to go from, 92% excellence to 97% excellence in a short period of time. Like that's kind of the ideal archetype of founder we like to work with. Yeah.
Love it. Well, Arjun, thanks for coming on the program. We're at time. I could talk to you for, like I said, another hour or two about this stuff.
It's been a pleasure. This has been a lot of fun. Thank you for your thoughtful questions. Yeah.
Thanks so much for coming on.
All right.